Hello, everyone. It's really great to see so many attendees here. Gosh, we weren't expecting that much. So thank you everyone for joining our live webinar on the national budget. I know many of you have very busy schedules, so thank you for making the time to spend some time with us this morning. I hope you enjoy it and find it instructive. So today's webinar is going to be about the budget speech that I'm sure most of you would have heard last Thursday. And this was the Honourable Minister's first budget speech. So it was much anticipated. Everyone we were all wondering what was going to come out of it, and it was obviously made in very difficult circumstances. I think the effect of the COVID-19 pandemic, we're still reeling from all the circumstances that we had to go through in the last few months. In particular, things like ranging from the lockdown to the way that we had to rearrange how we live and work, and obviously the economic effects. And everyone has been waiting to see what was going to come out of this budget in terms of rebuilding and re-energizing and rebooting the economy. So the budget came out, and I think it's fair to say that emotions have been running high since last Thursday. We've heard a lot of things from one quarter to the other, going from applauding the minister for being like a Robin Hood type budget, I've heard, and others criticizing the contents of the budget for hindering entrepreneurship and investment and creation of employment. So the purpose of this webinar is not to indulge in these emotions, but to take a step back and try to look at some of the tax and legal measures that were contained in the budget and try to unpack them a little bit and look at the broader implication from a legal and tax perspective. So I am joined today by my two colleagues, Nadiah and Zuleikha. Hello, girls. Nice to see you. Hi. And I also have the great pleasure of welcoming Mr. Joe Chan and Zaynab Hisaund from Atax Advisors. Welcome.
Thanks, Johanne. Hello, everyone.
Very excited to spending some time with you this morning to talk about the budget. So I think before we start, a couple of housekeeping rules. The webinar is meant to run for about an hour. We'll have a very short break halfway through. It's divided very broadly into the tax section and the legal section, and we'll break halfway through, and we'll also have a poll for you guys to take. We have a Q&A tab. You'll see at the bottom of your screen there's a Q&A tab. Feel free to drop down your questions as we go along. We'll try to answer as many of it as possible at the end of the webinar. We have about 15-20 minutes that we've earmarked for that. So please feel free to drop your questions. I think without much ado, I will kickstart the discussion. I think many of you will be expecting to hear about one of the most controversial measures of this national budget, which is the 400% hike in the solidarity levy. I think this has taken us all a bit by surprise, and obviously strong emotions associated with that. So, but looking at the measure itself, if I can ask you, Joe, two of the questions I think many people had before we actually looked at the content of the annex is, first of all, is this a tax? Is the solidarity a tax? Because I've heard some people saying, no, it's not a tax, it's just a levy. And the second question is it only the rate of taxation that has changed? And can you give us a practical example of what the effective tax rate of an individual will look like pre and post budget? Over to you, Joe.
Thanks, Joanne. Thanks for the kind words. And we at Atax are also pleased to note that there are so many attendees in this webinar. And when we are sure that at the end of this webinar, you will have enough food for thought. And I know that after 1 hour, you will all have your lunch time. And maybe the issues that we will be raising during this webinar will be a topic for lunch conversation. Now, Johanne, let me give you a brief historic of solidarity levy for individuals. In our income tax legislations, we also have solidarity levy for telephony companies and other types of companies. Solidarity levy for individuals were introduced in the Finance Act 2017-2018, but this is effective as from income year ended 30th of June 2018. If we turn to the budget speech of the then Minister of Finance, this measure was introduced with the view to reduce inequality. Okay, and now, how does this solidarity levy works now? Solidarity levy is applied. Solidarity levy is applied on leviable income. And what is leviable income? Leviable income consists of our normal taxable income, which for an individual, for a salary earner, we refer to as salaries, wages, other perks, other benefits in kind. And we include dividend income from resident companies, dividend income from registered cooperative society, and distribution of profit from resident society and succession. But this leviable income will not include lump sum that we will get at our appropriate retiring age, will not include any death or injury gratuity. Now, the whole of the leviable income will not be subject to tax. The solidarity levy of 5% will be applicable on the excess of 3.5 million of the leviable income. Johanne, to answer your question whether solidarity levy is tax or not, let us look at the definition of income tax in our Income Tax Act. As we will see on this slide, income tax means the income tax imposed by Section 4, that is on the gross income, and includes the levy imposed by Subpart B, Subpart AB of Part 3. And if we have a look at Section 16B and Section 16C of the Income Tax Act, which talk about solidarity levy on individuals, this Subpart AB of Part 3 is in fact solidarity levy on individuals. And to call a spade, yes, solidarity levy is a tax imposed under the Income Tax Act 1995. And it is also interesting to note that failure to pay solidarity levy at the appropriate time will also entail penalties and interest in the same way as if we have not paid our tax, our normal tax. Okay. Now, what pre-budget, as we can see on the slide, the solidarity levy is 5% applicable on leviable income above 3.5 million, and this solidarity levy is payable at the time we submit our annual tax return, that is by 30th of September when we file our annual tax return. What will change post-budget if the law, if the Finance Act confirms the rate of 5% and the threshold of 3 million rupees, this solidarity levy will be based on the PAYE basis. That is, all those who are subject to solidarity levy, they will have to pay their tax on a monthly basis under the PAYE basis. Now, you have asked me to show an example on what will happen pre and post budget on the effective rate of tax. Now, let us look at the case where an executive of a company is receiving an annual salary of 6.5 million rupees, dividend income. Then you will see that pre and post budget, there will be an increase in 121% on the tax bill. In the post-budget column, you will also see that we have included the CSG. This CSG will be dealt later by our panelists, and we will show to you that this CSG is in fact a tax that is being levied on our income. So, as I mentioned previously, post-budget compared to pre-budget, if we take this example, there will be an increase of 121% in the tax bill of this same individual. Not to forget to mention that the same individual would have been subject to tax for the year ended 30th of June 2017 at the rate of 15%. His dividend income would have been completely exempt. So within a period of 2 or 3 years, you will see, for this example, there will be an increase in 121% on the tax bill. And if we go further down this worksheet, you will see that the effective tax rate pre-budget will be 20%, and post-budget, the effective tax rate will be 43.3%. So this example depicts the picture of someone who will be hit by the measures that has been announced in the budget speech.
Thank you, Joe. I think that's very clear the way you've broken it down into the various sources of income. And I think, redistribution of wealth is all well and good, but I think that some of the very strong emotions that's been associated with the criticisms of the solidarity levy is the discriminatory nature. Because it used to apply to all Mauritian residents, regardless of their nationality, and suddenly, the budget speech and the annex make it very clear that it will only apply to Mauritian citizens. So a lot of the criticism was around the discriminatory side of things. So I have two questions for Nadiah. And drawing from some of the criticisms that we've heard, the first one is the discriminatory treatment a harmful tax practice? As you know, we've had to significantly overhaul our legislation in the past 2 years to deal with some features of our global business regime that was treated as being potentially harmful tax practice, the ring fencing between GBC1 and domestic companies, the existence of GBC2. So we overhauled all that, got rid of all of that. So by now putting more ring fencing or new type of ring fencing, is this a harmful tax practice? And the second criticism I've heard is that it infringes the principle of equality, it's anti-constitutional. So Nadiah, could you enlighten us on your views on those 2 points, please?
Thank you, Johanne. We've taken the view that it is not a harmful tax practice as per the OECD meaning, and as you've explained, the concept of harmful tax practice arises from the BEPS project, and we see that the BEPS project is mainly targeted towards entity. So, as you've said, we've now taken steps as a jurisdiction, and we're now rated compliant in terms of the Forum on Harmful Tax Practices. We've taken steps, you've said, in respect of any preferential regime or ring fencing. And I've had a look over the past couple of days about the numerous OECD reports issued on the matter. And every time we're talking about a preferential regime, which is one of the key factors that you use to identify a harmful tax practice, or when you're talking about ring fencing, the OECD focuses on regimes related to financial services sector or other sectors such as shipping or insurance. So we don't think that this is something that is targeted towards individual, and therefore we do not think that this is a harmful tax practice under the meaning given to it by the OECD. Perhaps one other thing, Johanne, before I move on to the question of constitutionality, I think a lot of people have been talking about substance as well. And the issue is for individual, the issue of substance will not arise if the tax resident in Mauritius, because they will in any case be spending a considerable amount of time in Mauritius to be tax resident. So this will mean that there is no issue of substance there. And another thought that has cropped up, and I would like your views on this, Johanne, even though you're our moderator, is the interaction of this solidarity levy with the anti-discrimination provision found in most tax treaties. So the OECD model tax treaty, for example, has an article, Article 24, and that article seeks to prevent discriminatory treatment between nationals and non-national in relation to taxation. And I think there has been many people trying to link this to what is currently happening with the solidarity levy. So do you want to share your thoughts on this, Johanne?
Yes, I think that I mean, let us be clear. I'm all for principle of equality and non-discrimination, but I think linking the OECD Convention with what's happening here is two different things, because the non-discriminatory article in the Model Convention deals with when there's a double tax treaty that applies. So, for example, if I had a Mauritian national and resident who had property in the UK and who's renting that property out, receiving rental income, and then I had a British national who is resident in Mauritius and is doing the same thing, renting property in the UK, receiving rental income. Now, there would be a discriminatory treatment if the MRA, for example, allowed the British national to claim a credit in relation to the tax suffered abroad, withholding tax on rental income, for example, but didn't allow that from the Mauritian national. So there's a double tax treaty at stake here, and you're discriminating and going against the non-discrimination article in the convention. But I think that it's a big leap to equate the Model Convention and the commentary on the Model Convention to something that applies in a purely domestic context, when obviously a state can sovereignly determine how to apply that. And I think that also links into the constitutional point, because we've debated that at length, Nadiah, and I think it's very clear in case law. But I'll let you talk about the constitution.
Thanks, Johanne, and thank you for the helpful example. I think when we're talking about the anti-discrimination provision, it's always helpful to have an example, and I think we're quite clear on the fact that these provisions contained in treaties, they do not arise, it cannot be triggered in a purely domestic context, and this is what we're talking about when we're talking about the solidarity levy. So now, turning to the anti-constitutionality of this measure, I think quite simply the answer is that it is not, in our view, it is not. And we've read a couple of judgments handed by the Supreme Court, and namely in the instance of the campement site tax in the 90s, so that there's a landmark judgment. The judgment was delivered by Judge Lala, and where this very same issue was examined. So we're talking about constitutionality, but we're also talking about the equality of treatment. And in this case, it was quite clear that these type of measures are not unconstitutional, because there are limited grounds on which different treatment to different person is not permissible. So to answer your question, Johanne, in our view, it is not.
Sorry, I think Nadiah is having some issues with her network. So just to wrap up on what she was saying, I think it's clear in our judicial precedent that tax is discriminatory in nature. It's an allowable item that permits discrimination under our laws. So we cannot argue that because someone is being taxed differently than someone else, that it's discriminatory and therefore unconstitutional. And this has been established by case law. So I think that just to wrap up on the solidarity levy, because we have a lot of topics to go through. Joe, if I may ask you now, suddenly we're seeing a wide difference between the tax treatment between companies and individuals. Before it was quite simple: 15% everyone, 2% extra for 2% extra for CSR. But we're seeing that gap widening between companies and individuals, and also there's also the concern about dividends effectively now being taxed twice, because obviously the dividends have already been taxed at the level of the company. And now when you're receiving it as an individual, you're effectively paying 25% on it. Do you have any comment on this, Joe?
Yes, Johanne, thank you for your question. Now, you see, the Mauritius Financial Center has been established in such a way that during roadshows, when we are marketing Mauritius as a place to invest, when we were marketing Mauritius as a place where it is good to live, with a bon vivre, Mauritius has always been marketed to be as a jurisdiction where the tax system is simple, where the tax system, where everyone, both corporates and individuals, pay tax at the rate of 15%. This tax system has proved to be a game changer. This tax system has attracted Mauritians who have settled abroad to come to live, to work, and to invest in Mauritius. Now, based on this, when we go to the speech of the Minister of Finance, we can see that the Ministry of Finance has mentioned Mauritian citizens, meaning that will only Mauritian citizens be subject to the 25% solidarity levy? What will happen to non-Mauritian citizens? Now, with the impact of COVID-19 on the Mauritian economy, we would have expected that the tax system would encourage entrepreneurship, that the tax system would encourage investment, and that the tax system will alleviate the cash flows of an individual who is deriving income which is subject to this solidarity levy. Now, this introduction of the tax rate of 25%, of the solidarity rate of 25%, will decrease consumption and savings. And most importantly, we have seen the effect of the increase in tax rate over years. In our example, we have seen that the individual has been subject to an increase of tax at the rate of 121%. However, if we compare Mauritius to other IFCs, we will note that to face the challenge of COVID-19, the Singaporean government has decreased tax rate to 9%. So just to give you an example on how tax can affect the economy of a country. Now, Johanne, to answer the question, yes. Now there will be double taxation of dividend because corporates do not have this dividend as a tax deduction, and individuals who are subject to solidarity levy will now pay tax on dividend income.
Thank you, Joe. Thanks very much. I'm afraid I'm just going to have to move a bit quicker now because we haven't we've just brushed the solidarity levy and we have lots more to go through. So I also want to talk briefly about the group taxation. This was quite a surprising measure. Over the years, there's been a number of representations made by the industry to the Revenue Authority to incorporate the concept of group relief in our legislation, and so far nothing to that effect has been incorporated. But suddenly we now hear about this group taxation. Taxation, it's called a levy, I believe, in the annex, levy on corporates, affecting companies having gross income exceeding 500 million. It talks about also taking into account the turnover of the gross income of a group exceeding 500 million. So that's quite an interesting measure, Joe. What do you think about it?
No, Jean, we must wait for the enactment of the finance bill to have the proper definition of group of companies. If we fit this in the Mauritian context, we will see a scenario where we have the parent company in Mauritius and the subsidiaries companies are also in Mauritius. So application of this levy would be fairly simple. But where the hurdle lies is where we have a subsidiary in Mauritius and the parent company is outside of Mauritius. Do we have to consolidate the gross income of all those entities to apply the solidarity levy? The other situation is where we have the parent company in Mauritius and the subsidiaries outside of Mauritius. Do we have to consolidate the income of both the Mauritian parent company and the foreign subsidiaries? This we do not know. We will have to wait for the enactment of the finance bill to have better clarity on this. Okay, Johanne, as you mentioned in your introductory remarks on this aspect, it is good, but now the concept of group taxation is becoming visible in the tax scene of Mauritius. Let us hope that in the future we can see group tax relief. This will be an added. This will foster the image of Mauritius as a jurisdiction where we can invest.
Thank you, Joe. Now over to Zaynab to talk to us a little bit about VAT. We heard the announcement that digital and electronic services provided through the internet by non-residents for consumption in Mauritius will be subject to VAT. Now, I think the first thing most of us thought about is that our Netflix subscription is suddenly now going to become more expensive. So I'm really keen to start to hear about that. So Zaynab, do you think that VAT is the appropriate mechanism for taxing digital services?
Yeah. Thank you, Johanne. So indeed, the finance minister announced that digital and electronic services that are provided through the internet by non-residents for consumption in Mauritius will be subject to VAT. Unfortunately, not much details have been provided, but while looking at, for example, the law in South Africa, what I can say is that it's applicable on exactly the Netflix subscription is one of them. Or a cloud-based software, ebooks, or online games. Now, the question of whether it is appropriate and how it will operate in practice, it actually raises a lot of questions in our minds. For example, will the non-resident be required to register for VAT in Mauritius, or will there be a need to appoint a local representative? And also, who will actually bear the burden of collecting the VAT? Will it be on the final consumer, who might be an individual and not being VAT registered? So this would be very challenging. And we've also heard that maybe a different VAT rate would apply to digital services. So those questions actually arises. So we are just hoping that the Finance Act will shed more light on how it will operate and what the exact scope will be. And now, if you look at this slide, we can see that across Europe and Africa, many countries have adopted tax on digital services. However, each country have their own provisions. So in some, it might be in the form of a direct tax. In other countries, in the form of an indirect tax. But if we look at what the OECD says about it, so digital economy has actually been identified as one of the main focus areas of BEPS, and this is the reason why the Action Plan 1 has been developed. And in November 2019, the OECD actually developed, they actually proposed the adoption of Pillar 1, which is the so-called unified approach to tax digital services. And the aim of that unified approach is actually to replace any unilateral tax measures adopted by individual jurisdiction to ensure a fair taxation worldwide. And now, if Johanne, if we deep dive into that proposal, we can see that a three-tier profit allocation system is being proposed. And the objective is to grant the taxing right to the country where the consumers actually reside. And on what it will be taxed, it is on the portion of the service provider's profit. So when we look at the word profit, that word is very important, because usually when we talk about profit, it is linked to direct tax and not indirect tax. So in Mauritius, when the budget talks of VAT being an indirect tax, it actually poses the question of whether it will be compliant with the OECD's proposal. So we are expecting the final report from the OECD to be finalized by end of this year. So for our recommendation would be maybe it's not appropriate to deal with it now, and we recommend the government to actually wait for OECD's final report before making a decision.
Thank you very much, Zaynab. That was very useful. I think quickly we'll wrap up on the tax sections because we're already halfway through the webinar, and we're just going to touch on the partial exemption very quickly. Now, for those of you who work in the global business sector, you would be aware that our deemed foreign tax credit regime has been abolished and replaced by a partial exemption system instead. Now, lo and behold, there's one paragraph of the budget speech in the annex dealing with the partial exemption regime, and it doesn't seek to broaden it, it seeks to narrow it further down. So, yeah, I was going to say I give up, but I won't say that. So, Zaynab, what do you think about that?
So to start with, Johanne, the partial exemption was actually introduced in last year's budget to replace the existing deemed foreign tax credit. And this was a major reform to our global business sector. Unexpectedly, so it has been narrowed further. So the finance minister announced that the eligibility to claim the partial exemption on interest income for 6 categories of businesses that you can see on the slide have been removed. So, and from the budget speech, we can see that partial exemption on interest will only be available where the core income generating activity of the business, of the company, is actually to derive interest income. But if we have a look at OECD's guidance, if we look at the OECD's progress report on harmful tax practices, at the definition of core income generating activity, it does not actually refer to main business activity to be generating interest income to avail of the tax exemption. Therefore, the meaning assigned to SIGA in the budget, in my view, is not fully in line with OECD's interpretation. So, and unfortunately, as you rightly said, Johanne, our partial exemption has been narrowed, and this may prove detrimental to our economy.
Thank you very much, Zaynab. I can only hope that the representations will be taken on board and consultations held, because there's still a bit of time before the finance bill is issued. So I hope that some of these concerns will be taken into account for the good of our global business sector. So I think we're going to take just a 2-minute break now, very, very short, just to be able to do the poll that we were planning to do. And you can have your toilet break if you wish to. So very quick 2-minute break, and I'm just going to ask our administrator if you can just put the poll for our participants. Thank you. Right, I hope you've enjoyed your break. So now we're going to start with the second section of this webinar, which is the legal aspect. Now, obviously, a really fundamental structural reform was announced, came as a bit of a surprise during the budget speech, and that's the introduction of the contribution sociale généralisée. And the NPF is going to be abolished as a result. So I'm going to ask Zuleikha to tell us a bit more about what is this CSG about, how is it different from the NPF, what exactly is going to change for the everyday lives of the retired person.
Thank you, Johanne. First of all, I would like to say that it's important for our audience to understand that there are 2 types of pension systems in Mauritius, the contributory pension and the non-contributory pension. So the non-contributory pension is basically the universal basic retirement pension that every Mauritian gets upon reaching the age of 60. It is funded by the government, which means that there's no direct contribution that is made to receive this pension. And it's approximately 9,000 rupees right now. And the government promised that this will increase to 13,500 rupees by 2023. This pension is received irrespective of whether a person has worked during his lifetime or not, and whether the person has worked in the public sector or in the private sector. And it's equal for everyone. On the other hand, the contributory pension system consists of the National Pension Fund and the National Savings Fund. So these two pension funds, they concern employees in the private sector, and they are mandatory as well, which means that the employee and the employer have to contribute to these funds every month. And the benefits that are received from the NPF and the NSF tops up the basic retirement pension of 9,000 rupees. So for the NPF, I'm just going to show you on a slide. So as you can see from the slide, for the NPF, employees are usually contributing 3% and employers are contributing 6% of monthly on basic salary. And there is a cap value of 18,740 rupees. This means that any salary above this amount will not be taken into consideration when calculating the amount of contribution that a person has to make to the fund. To explain this, it means that, for example, a person who's earning 100,000 rupees and a person who's earning precisely 18,740 rupees will be contributing the same amount to the NPF. So in exchange of for this contribution, employees receive pension points, and the amount of benefits that a person will receive when he retires will depend on the amount that he contributed and the pension points that he received throughout his career. And he will be entitled to this benefit at the age of 65. Now turning to the contribution sociale généralisée, which is the new pension system which is being introduced by the government. So first of all, I would like to say that I cannot speak with certainty because there are many points that need to be clarified by the government. But as far as we understand from the budget speech, the NPF will be replaced by the CSJ. And the CSJ will be basically a sort of hybrid system. Basically, it's going to be partly contributory and partly non-contributory. And I will explain why I say this. So under the CSJ, an employee who earns less than 50,000 rupees will contribute 1.5%, and an employer will contribute 3% of the monthly salary. On the other hand, an employee who earns more than 50,000 rupees will contribute 3%, and his employer will contribute 6% of his salary to the CSJ. So this means that a person who's earning less than 50,000 rupees will contribute less to the CSJ, and a person who earns more than 50,000 rupees will contribute more to the CSJ. However, when it comes to the benefit received, everyone will receive the same benefit. So what I mean by that is that the government is saying that it's going to use the CSJ to fund any increase in the basic retirement pension. So as explained earlier, the government promised that the basic retirement pension of 9,000 will increase to 13,500 by 2023. And the CSJ will be used to fund this increase, the 4,500 increase. So everyone will receive the same increase. And so to come back to your question, one of the main difference between the CSJ and the NPF is that the benefit that will be received under the CSJ will not be proportional to the contribution that is made to the CSJ, unlike the NPF system. So an employee who contributes more to the CSJ will receive the same amount of benefit as an employee who contributes less to the CSJ. It will be a more like généralisé. It's not going to be individual based. So that's the main difference between the NPF and the CSJ. I hope that I answered your question. I hope that I answered your question, John. I think, yeah, there's a problem with maybe you're on mute, I think.
Hi, sorry about that. Thank you, Zuleikha. That was very helpful. And actually, talking about this new structural reform, we've done some research, and there's actually a similar kind of system in France, perhaps not exactly the same, but there's also this concept of charge sociale généralisée in France. So, Nadiah, can you tell us a little bit about how does this announcement compare with the French version? Is it similar, and what is it used for? Is it a tax? Is it does it go toward pension? Does it go towards funding public debt? Can you shed some light on this?
Sure, Johanne. I think when we heard of this new charge sociale généralisée, we were all very curious. So obviously, it's always tempting to look at how other systems operate and to have an indication of how things may unfold here. So before I start, we're not French lawyers, but we have spoken to people who have dealt with this system in France. And what I'm going to explain is based on our understanding of what they explain. So first of all, Johanne, your first question was whether it was a tax. Yes, it is considered a tax in France. That is its characterization. The second thing is, I think it's quite interesting, is that there is an element of deductibility in respect of that contribution. So you can deduct it against your income tax in general. There is no mention of this in the speech. Thirdly, perhaps something that's also quite interesting is that we understand that the employer does not contribute to this charge. So he contributes at his own personal level as a taxpayer, but he doesn't contribute on behalf of his employee. And lastly, I think you asked whether for what was the purpose of this contribution. So it's very clear there, from what we understand, that it is used to fund, to service public debt and to provide for some other sort of allocation for the public good. So yes, so we await further detail, to be able to work out exactly how this will sit with our existing, system. Thank you, Johanne.
Nadiah. Thank you. So just a couple more topics to go through before we've got Q&A. There's only 10 minutes left, but we do want to touch on a couple of topics before. First of all, very briefly, the EU blacklisting. We won't delve into the technicalities of the EU blacklisting. I'm sure many of you would have attended at least one of the very interesting webinars held this week on the EU blacklisting. So we're certainly, the objective is certainly not to delve into the technicalities of that, but I'll be interested to hear whether the budget provides for anything on that. Nadiah, it will be also very refreshing to hear a women's point of view on that after the two webinars for change.
Thanks, Johanne. Sure. So what we find is that the budget shows firm resolve to deal with this issue heads on and to remove Mauritius from the blacklist. So I'm not going to go in all the measures that the budget proposes, but what it shows is that we'll have a new, a solidified and overall more technical AML and CFT framework, and that we and that these legislation will reflect the remaining FATF recommendation that we have to meet by September 2020. Now, a couple of the proposition is that we'll have increased reporting of suspicious transaction, risk-based supervision. I'm sure you've all heard that draft guidelines have been issued for law firms, etc. Timely access to beneficial ownership, and also a financial services court that deals with money laundering offences. A dedicated financial services court will also be set up. Now, I think we've gone through why Mauritius was on this list. It comes as a result of the FATF listing, and that provided a irrefutable presumption of us being a high-risk country. We obviously await the legislation that I'm sure will be very thorough and that will address the issues. But however, I would be remiss not to say this. We must say that whilst the list comes into effect in October 2020, we have already seen counterparties exercising a certain level of caution. And in terms of reputational damage, we fear that, alas, an arduous task will await us. So that is what I would take on the blacklisting from the budget perspective.
Fully agree with you, Nadiah. And linked to that, obviously, is the global business sector. What is the future of the global business sector, considering the important role that it plays in the economy? As the deadline of June 2021 fast approaches, being the end of the grandfathering period, I think we were all very keen to see what was going to be in the budget in terms of revamping that global business sector. Again, I think it would be an understatement to say that it has been underwhelming. So Nadiah, what did the budget provide to revamp that sector?
Yes, Johanne, as you rightly pointed out, GBCs will now face a new normal where the deemed foreign tax credit is now a thing of the past. So we're looking at new products, we're looking at new things that can diversify our financial services sector. So the budget does contemplate a couple of products. So these are products such as insurance wrapper, variable capital companies, green bonds, etc. And we yet have to see the granular detail on these products. But I would like to make one point, is that these products are obviously welcome and exciting, and but we should ensure that they are aligned with the partial exemption regime to be competitive and to attract investors. I also note, Zaynab previously spoke about the narrowing of the partial exemption regime, which is obviously not ideal. So we'll have to be attentive to the legislative framework in respect of those new products. And secondly, on the subject of partial exemption regime, which will be the reality of many GBC companies from now on, we had hoped that there would be clarity on the interpretation of the substance requirement, as there is in other jurisdictions. We unfortunately find that we have to turn to those other jurisdictions to be able to understand in a practical and concrete manner, the substance mechanics. So this is also something we had hoped that we would see, but we never know. Thank you, Johanne.
Well, hopefully the finance bill will deal with that. As you said, Nadiah, we often find ourselves when writing opinions having to look at the Channel 9's guidance notes, for example, in interpreting SIGA. So let's hope that the finance bill that there will be practice guidance notes issued by the MRA after. So this is the end of the 6 topics that we wanted to talk about. We'll take some Q&A. We've got a number of questions already. And we actually received some questions before the webinar. We received my favorite question had to be what tax optimization structures do you recommend in relation to the solidarity levy? Now, as you know, you should all pay your taxes as and when you're due, as and when they're due, and as I'm sure the participants from the MRA today will agree with me. However, if you feel that your structure is tax inefficient for whatever reason, I'm sure Zaynab and Joe will be more than happy to help you if you reach out to them after this webinar. Now, taking another question. So got a question on dual nationality. So someone who's British and Mauritian, do they have to pay that 25% solidarity? Now, as we said, we haven't seen the legislation yet, but at first blush, yes, because if it applies to Mauritian nationals, then that means that it applies to you unless you renounce your Mauritian citizenship. So my answer would be yes, it does apply to you. Question for Joe, and I actually got a question, the same question from a couple of other people as well. So is the solidarity levy applicable on taxable income or total income? Can you clarify?
The solidarity levy is applicable on the leviable income. That is, we take our taxable income plus dividend income, and then we subtract the 3 million rupees, and whatever in excess, we pay the 25% on this. So this is how solidarity levy works. It is on the excess of the 3 million rupees over our taxable income plus dividend income.
Thanks, Joe. And how do you calculate the effective tax rate?
Now, what we have done is that if we go to the slides, then we should go, Zaynab, share the slide.
Yes.
Now,
Yeah.
if we go to the slide, you will see that the three last rows, we see that the effective rate on leviable income, which is the 5%, we take the exempt, we take the leviable income, the tax on the solidarity levy. Say we take if the pre-budget the 275 million, and we divided it by the leviable income. Then we will have the rate of 5%. The tax rate is 15%. We take the amount paid. Say if we say pre-budget the tax liability at 15% of 900,000, we divide it by the actual amount of the chargeable income, the taxable income of 6 million. So we take those two totals: the tax rate on leviable income, the effective tax rate on taxable income. Then we have the total effective tax rate. But an individual who is subject to solidarity levy will suffer.
Thanks, Joe. I think that's very clear. I think it's very, if obviously the law hasn't been published yet, but if it is as it's currently worded, it doesn't apply on an after-tax basis. It applies on the, as you say, the leviable income, so the chargeable income of the individual, including the plus dividends above 3 million if the law isn't changed. Now I'm going to take another question. I'm not sure you'll be able to answer that if the budget was silent on it, but Zuleikha, will CSG also apply to government officials? If not, is it not discriminatory that only employees from the private sector will be subsidizing the universal?
Well, yes, I think, John, you're right. I think this is a question that many people are asking themselves because, as I said, the basic retirement pension is applicable to everyone. Everyone gets it, whether you're in the private sector or the public sector. But the CSJ will be used to finance this increase in basic retirement pension. So it is actually unknown whether the benefit under the CSJ will be applicable to someone who is from the public sector and someone who has never contributed to the CSJs. So I think this is something that needs to be clarified by the government, definitely.
Thank you. And one last question before we wrap up. Do you think that the new budget measures will encourage the practice of tax arbitrage? My personal opinion, I'll ask Zaynab and Joe what they think, but my personal opinion is absolutely yes, because the gap between the treatment of companies and the treatment of individuals is widening. We used to have a very simple tax system. Unfortunately, I think with the massive hike in the solidarity levy, it might encourage tax arbitrage. Joe, what do you think?
Yes, I fully concur with you, Johanne. You see, if a company invests in a Mauritian resident company, whatever amount of dividend the company will receive will be tax exempt. And then the individual, he will be subject to solidarity levy at the rate of 25%. So this will leave room for arbitrage.
Thank you. So I think it's noon now. You must all be quite hungry. I'm just going to wrap up. Thank you for all your time. Thank you for your patience and for attending. We were very pleased to see you in so many numbers. I'm just going to ask each of the panelists to just share with us in one word, how would you describe this national budget 2020-2021? Nadiah?
Oh, lukewarm.
Zuleikha?
I would say unexpected.
Zaynab?
A non-IFC friendly budget.
And Joe?
A high tax budget.
Okay, so on this note, thank you all, and we hope to hear from you. Please don't hesitate to drop us a line if you have any questions that we haven't answered.
Thank you. Bon appetit. Bon appetit.
Thanks. Bye-bye.
Bye.
Bye.